Welcome, everyone. Thank you all so much for joining us today. My name is Luana Lewis. I'm the Senior Vice President for Programs and Services at the Better Business Bureau serving Metro New York and its Education and Research Foundation. And with me today is Sean Van Gorder. Sean?
Hi, my name is Sean Van Gorder. I'm the Director of Charity Evaluation for the BBB Wise Giving Alliance. So let's go ahead. Just one note, we are recording this session, so it'll be available for use for attendees. And also, as we're moving along with the presentation today, if you have questions, feel free to add them into the chat, and we will come back at the end of the presentation, time permitting, and answer your questions.
There we go. Take it away, Sean.
All right. Well, let's get started just with a little bit about the standards themselves. So the BBB standards for charity accountability were developed by the BBB Wise Giving Alliance and a national panel of experts with input from the nonprofit sector, from donors, from government, from businesses. We sought a lot of feedback when developing the 20 standards. And they cover four main categories. There are 20 standards covering governance and oversight. So you may think of the activities of your board of directors. Finances, which is sort of what people think of when they think of accountability. Measuring effectiveness. Nowadays, this may be more commonly known as impact assessment. And fundraising and informational materials. And in addition to the 20 standards, we have some recommended practices that are in the preamble to our standards, including looking for charities to commit to diversity and pluralism, particularly in their board of directors, as well as, of course, adherence to both federal and state and local law, and also prioritizing openness and ethical behavior in general. There are a few guiding concepts that go into the 20 standards. First of all, our process is fully voluntary. We don't seek out or obtain information without the charity's participation in our process. We are committed to accuracy of reporting and solicitations. This is something that comes with the territory as part of the Better Business Bureau, right? Committing to that. Donors will not be misled, and that charities should be clear on how they're using donors' donations. And then when you're looking at governance, we're also committed or guiding concepts in development of the standards was the duties of care, loyalty, and obedience of the board members of an organization. These are built into our standards when we look at things like active oversight of financials or making sure that the board is acting in the nonprofit's best interest and that they're in compliance with all, like as I said, federal and local law and policies. And then also, the focus for a nonprofit organization is the achievement of their mission. And so the standards are aimed at making sure that that is the charity's focus. We evaluate key practices. We do not rate a charity. So we do not say, give them a letter grade or a star grade. Either an organization meets our standards or they don't meet the standards. We have a commitment to generally accepted accounting principles. When it comes particularly to our financial standards, we rely on GAAP as sort of the law of the land when it comes to accounting. And a GAAP compliant financial statement is our preferred source of information for financials if the organization has one. Obviously, there might only be a 990 or a 990 EZ to work with. But an audit is definitely a preferred source of information. And it's important to note, and we'll get into this a little bit later, that for us, accountability is more than just financials. As I mentioned, a lot of donors think only about financials when they think of accountability. But for us, there's a lot more that goes into it in those four areas that I mentioned of our standards. So what's the benefit for what we do? We produce reports for the public. We make them available to help them make a giving decision. They can check bbb.org or give.org to see whether or not a charity meets our 20 standards. And we also have the BBB seal for charities, which is a logo that can be added to a charity's appeals or their website if the organization is accredited. So it's sort of a shorthand way for donors to know that an organization is trustworthy and meets our standards. The benefit for charities is really that our standards are helpful key practices, and just the act of working to meet the standards can be helpful, whether we're producing a report on you or not. Looking at our 20 standards might be helpful to you to see what these key practices are that we developed for nonprofit organizations. Any charity that meets all 20 of our charity standards is automatically considered a BBB accredited charity. So just the act of going through the process and meeting all 20 standards makes you accredited. And there's no fee for that process. Submitting information to us, if there are issues, working with us to fix any potential standards issues, that whole process is completely free to the organization. The BBB seal that I mentioned, there is a fee associated with that process, but it's optional. Any charity that meets all 20 standards that becomes accredited has the option to sign up for the charity seal, and that does involve an annual fee and license agreement that the organization signs in order to be able to use our logo on your appeals and website and other materials. And it's important to note that each local BBB sets their own fee schedule. So depending on where you're located, the BBB that you're working with will be able to tell you what the fee schedule is. Generally, it's a sliding scale based on your revenue. Just I encourage you to reach out to your BBB if you have questions about the seal process. And then here's an example of what our charity reports look like. This is an example of an accredited charity report. We have the matrix at the top that shows whether shows all 20 standards and whether each standard has been met or not. Then there is some basic information just about your organization, description of your programs, identifies your CEO and governance information, and then of course a financial summary based on the financial information that you provided to us. So not everybody is eligible to have a charity report completed. So I just wanted to go over quickly who we do and do not report on, who is eligible. So those that are eligible is any 501c3 or 501c19 organization. Those are the two 501c types that we evaluate or that we report on. In addition, they have to receive contributions and grants. And also, they need to solicit the general public at large and not just a specific core group of individuals. So who we don't report on specifically are colleges and universities, private and community foundations, although that doesn't include federated organizations like United Way or community health charities. Those types of organizations we do report on. Hospitals, mostly, when you think of your local hospital system, it might be nonprofit. We don't report on them. However, other organizations that primarily get their funding through solicitation, through donations, we do report on those types of hospitals. All the other 501c types, 501c4s and others are not eligible. And then finally, places of worship that only solicit their parishioners, we can report on religious organizations, but if it's a local church and you're only passing around the collection plate or soliciting your parishioners, we wouldn't evaluate you. But if you have like a soup kitchen or a homeless shelter attached to your church and you're soliciting the general public, then you would be eligible in that case.
Okay, thanks, Sean. So let's dive in and start talking about the standards. Our very first standard is quite a big one, and it refers to how the board of directors actually governs the organization. And we look for evidence that the board is performing the fiduciary duties that they are supposed to perform in order to achieve actual oversight of a nonprofit. And that would include things like formally approving an annual budget, having a conflict of interest policy, and some states have regulations about that. Others may not, so check to be sure that you know what your state's requirements are in that area. And monitoring performance against conflict of interest and taking safeguards to avoid conflict of interest. Reviewing things like significant contracts and expenses. Obviously, your board wouldn't approve every small expense, but any major one, they should be aware of and be aware of contractual commitments around it. There needs to be a voting board member who oversees the finances, like a treasurer, doesn't have to have that title, but should perform those functions. And then reviewing things like your 990, which is in the nonprofit's annual statement to the IRS, financial statements and the management letter from an auditor. Your CEO's performance needs to be reviewed by the board every 2 years. And then when we are also, while we're not a government authority, we are looking for nonprofits to comply with applicable regulations. Now, we also have standard 2, a board of directors should have a minimum of 5 voting members. In some states, for example, that might be a smaller number. So again, be aware of your state regulations. There may be cases in which our standards go beyond state law. Why? Because we're looking for diversity of opinion and for nonprofits to be governed in a way that would avoid things like conflict of interest. Standard 3, board meetings, and in Metro New York, that was the most missed standard. We're looking for a minimum of 3 evenly spaced full board meetings with a majority in attendance. If you have more than 3 board meetings a year, we would look at the 3 with the highest attendance. During the pandemic, this became an issue, and I think one of the reasons why is perhaps some nonprofits didn't understand that we would allow things like Zoom or GoToWebinar or Teams or other online video meetings where you can see and hear participants and see and hear presentations. We'd count those as face-to-face meetings. But 1 out of the 3 meetings could be, say, a phone conference call. So please bear that in mind. Standard 4. This is a very important one. There should not be more than 1 or 10% of your board members, whichever is greater, who are either directly or indirectly compensated. So what is indirect compensation? That means any kind of thing with monetary value. You might have a board member who's getting free use of a car or an apartment that has monetary value, or insurance, or other benefits that have monetary value, or perhaps a relative of theirs is an employee or is receiving a financial benefit. All of those things might be looked at as a form of board compensation. It's not uncommon sometimes for there to be several executives from the organization who are compensated. That should not be the board chair or the treasurer, and the CFO should not be your board level treasurer. The chair also should not be someone who's performing the role of the CEO or chief operating officer, whether or not that person is compensated. And the reason behind this, again, like the chair should not be the treasurer. The reason behind this is to ensure that there's adequate oversight for the organization, and that doesn't occur if there are too many functions being performed by a single officer of the board. In organizations that don't have staff members and it's all volunteer driven, it's especially important to consider things like job descriptions for board members and to ensure that you don't have a single person performing all these functions. So standard 5, related party transactions. This is the conflict of interest standard. So you want to have no transactions, ideally, in which any board or staff member have a material conflicting interest with the charity. That's like a material benefit of some kind that arises from the relationship or affiliation with the nonprofit. So things that we might look at, this could differ from what the IRS would look at and what your state regulators might look at. So bear in mind, there are IRS regs around this, and the state, in your state law, might have regulations around that. We look to see whether the interested party, whether that's a board member or a staff member, participated in the board vote. Ideally, that person will stand apart from any board vote about a matter affecting him or her or they. Whether or not competitive bids were sought, the size and duration of the transaction, or whether it's a single transaction or ongoing on a regular basis for a long time. All of those are factors we might consider when determining if a conflict or potential conflict of interest has taken place. So standards 6 and 7 are frequently missed standards, and I think that's because they're poorly understood. They are very closely related. So standard 6 calls for charities to have a board approved policy of assessing at least once every 2 years in writing the organization's performance and effectiveness against its mission, with recommendations about future actions to achieve that mission. And why do we ask for that? Well, charities are tax exempt. They are tax exempt organizations that are favored. So there is an obligation to look every once in a while to see if you're actually achieving the mission for which you get that tax exemption. And that helps keep your organization from things like mission drift, keeps you on course. The mission is the anchor of your organization's tax exemption. Now, the policy should call for there to be a process to evaluate this success or lack of it with measurable goals and objectives that relate to the overall mission. We don't judge the process. We look for there to be a board commitment to engaging in this process. And what could that process look like? Well, more often than not, it's your strategic plan. If you revisit it at least once every 2 years in a written report that you make to your board about your progress against your mission goals and the recommendations you have for future actions. What could that be? Well, it could be a written strategic plan. It could be a board presentation on a PowerPoint deck, so long as that goes beyond an ordinary board update and focuses on how you are achieving your mission and what more you need to do to achieve that mission. Your policy could look like your bylaws if your board has voted on that and the bylaws commit you to doing this kind of thing. So these are very related standards. They are much easier to meet than people sometimes think. But it is important once you engage in this process to ensure that there is some kind of record of that gets passed down through legacy staff, because staff turnover sometimes affects whether nonprofits know that they have done this. So I'm going to turn it over to Sean now. Let me just mention charting impact. Charting impact is something that we did with several other organizations in the space. It consists of 5 questions. And if your organization answers these 5 questions and presents the result in a written report to your board, that would meet standard 7. And there are questions like, what is your organization trying to accomplish? What's your mission? What are your strategies for making that happen? In other words, measurable goals and tactics. What are your organization's capabilities for doing this? Do you lack some capabilities that you need to get? How will you get them? How will your organization know if you're making progress? Again, measurable goals. And what have you and have you not accomplished so far? In other words, what progress are you making against your mission? Now, over to you, Sean, for the financial standards.
Sure. So standards 8 through 14 are the financial standards, although only the first 3 are actually dealing with math, I promise. So standards 8, 9, and 10 are the ones that actually have the ratios which people think of when we're doing evaluations and reporting. Before we get into that, though, I do want to talk a little bit about the overhead myth. You know, a few years ago, we partnered with GuideStar and now Candid and Charity Navigator to sign 2 letters, one to the Donors of America and one to the Nonprofits of America, talking about what we called the overhead myth, which was the idea that the particularly donating public has become over-focused on ratios as a measure of trustworthiness or worthiness for donations for a charity. And the point that we were making with that, well, before we get into that, I do want to mention that this was a few years ago, but actually this is still topical today. Just last month, the BBB Wise Giving Alliance and BBB Metro New York both responded to a piece that appeared in the Chronicle of Philanthropy that was talking about this very issue. So it is still topical today. But the key points of overhead myth in general are that, on its own, overhead ratios are not a good indicator for overall performance, right? There's a lot of other things that come into accountability. We've already gone over a little bit of governance and measuring effectiveness. These are two other areas beyond just a simple financial ratio. So transparency, governance, leadership, results reporting, these are other things that everyone should think about before making the decision whether to give to a charity, not just what the ratios are. But I do want to mention that we're not saying that ratios are completely pointless, right? We do think that overhead spending should be kept reasonable. And when we're talking about overhead, we're talking about fundraising and M&G or admin expenses in compared to their overall costs. So there we go. So it is important to monitor your expense ratios in general. Why? Because, again, although we think that there should be more that goes into it, the media, government, and donors are still hyper-focused on these numbers. So it's something as an organization that you should be aware of. All right, so
Okay.
standard 8, program expenses. So this is the first standard dealing with ratios. We're looking for program expenses to be at least 65% or more of total expenses. Financial statements must break out program expenses versus total expenses. So when you're looking at your audit or even your 990, you'll see that it separates out program expenses from fundraising and G&A or admin or M&G. There's a few words for that third category, but this is dealing specifically with that program ratio. So it's total program expenses divided by total expenses to get to that ratio. Recent issues that we've seen with this is, well, primarily the most common issue we see is that sometimes the organization just may not have a good grasp or an understanding of what is a program expense versus other types of expenses. And a good rule of thumb really is just any costs that your organization incurs that is going towards fulfilling your mission is a program expense, right? So that's a good rule of thumb to go by when you get to that point of your audited financial statements or your 990. Go to the next slide. Standard 9 is looking at fundraising expenses, and this ratio is a little bit different. Standard 8, we were dealing with a percentage of total expenses, but in this case, we're actually dealing with a ratio of a percentage of related contributions. So a simple way to think of this standard is it's the cost to raise a dollar, right? So what we're saying is you should spend 35% or less of related contributions on fundraising. So no more than 35 cents to raise a dollar. So you can see here the calculation is your total fundraising expense divided by total related contributions shouldn't be more than 35%. So what are related contributions? Related contributions really is it's any kind of donation from the public. Now there's different forms of donations, right? So you've just got straight up cash gifts, donations from individuals. We also count grants from private and corporate funders as related contributions. We do recognize donated goods or in-kind goods. So if someone's donating clothing or food, that does count towards this number. Special events revenue is obviously donations, bequests, government grants, but not contracts. If it's a fee-for-service contract with the government, we don't count that. Just straight up grants is what we're looking at here. And then finally, membership dues, but only if there's not really a benefit to membership. If you're getting a strong benefit from the membership dues, then that's actually program service revenue, not fundraising related revenue. So that's just one example, one exception there. Standard 10 is the third ratio, and it's dealing with the accumulation of funds. And just a little bit about the background of why this standard exists. When we were developing the standards, we did a survey of the general public asking them, what do you look for in a charity that you want to give to? And the thing that we found strong in a lot of responses was they wanted to know that the charity had an immediate need for their donation, that they weren't accumulating funds without, spending it down in some cases. So in this situation, we came up with the standard: avoid accumulating funds that could be used for current program activities. Unrestricted net assets, so that's money that's cash that's available for use. should not exceed 3 times your last year's expenses or 3 times your current year's budget, whichever is greater. So another way to think of that is if you stopped raising money today and you didn't raise another dollar, could you continue operating for more than 3 years? That's really what we're looking at with this particular standard. Now we do subtract out fixed assets when we do the calculation. So anything like land, building, or equipment, some people might own the building that they're in, and that would sort of artificially increase their unrestricted assets. We do subtract that value out when we do the calculation. If the charity is over the limit, the 3 times limit, there is a way that they can still meet the standard without having to spend a lot of money, which might be unreasonable to expect. But the way that they could meet is to include a disclosure on their websites and all of their appeals that actually identifies what their unrestricted asset amount is. And the thought behind that is if you're allowing donors to make the choice at the point of solicitation, and you're saying, here's what our assets are, then you're overcoming that expectation that you don't have a lot in the bank. They understand at the point of solicitation that that's your position at that point. And the other thing is just keep in mind that we only look at, when we're looking at unrestricted versus temporarily restricted assets, if a board is designating, maybe they're setting up an endowment and they're setting aside some money, that is not considered a restriction. That money is still unrestricted. The only way assets become temporarily restricted is if the initial donor says you can only use this money in a specific way. That way it becomes temporarily restricted. Board designation is unrestricted.
Right, and I think actually the term temporarily restricted is now under FASB donor restricted.
Right.
No more temporary restrictions. Mm.
So standard 11 is dealing with the financial statements for the organization and making them available to everyone. So make available to all on request complete complete annual financial statements prepared in accordance with GAAP. Now, not everybody's required to have an audit. We have certain thresholds that we've set. If the organization is over $1 million in income, we'd look for a full audit performed by a CPA. If they are between 250,000 and $1 million, we would look for a CPA review. And if they're under 250,000, then just an internally prepared statement is okay. But it's important to check your state's laws because some of them are stricter, some of them are more lenient. But these are the minimum thresholds for the BBB charity standards. So, if we could go back one more.
Sorry, leaped ahead.
There we go.
Yep.
So standard 12 is looking at a particular table within the financial statement. So we would look for the organization's financial statements to break down expenses between programs, fundraising, and administration. And within programs, if a charity has multiple major program categories, let's say they have education and they're also making grants overseas for relief and development. Those are two different major program categories. So we would look for the expenses to be broken out even further between those categories. And if we go to the next slide, you'll see an example. This is referred to in the audit as the detailed functional breakdown of expenses. And it looks, this is a basic example, but it essentially looks like this. You have on the columns, you have the program expenses, fundraising, and admin. And on the rows, you have all of the common expense categories. So the reason this is so helpful is because it allows people to look at the table and see, well, what percentage of your salaries are going to fundraising versus programs? It gives a better picture of the organization overall. If we could go to the next slide. It's important, especially for board and staff, to be able to see this type of table, to see how the expenses are broken out, particularly when it comes time for budgeting for next year. It's helpful to see this information. In fact, usually the budget mirrors this table in some ways. And another thing to mention that this particular standard is actually, that FASB has changed the rules for audited financial statements to actually make this a requirement for nonprofit organizations to include this in their audit. The only thing is our standard might still be a little stricter when it comes to program expense breakdown, having it broken down by major program category. But this is something that is going to be built in when your auditor completes the audit. They're going to ask you to prepare this table as well. Also, if you're not completing an audit, on page 10 of the 990, that's an example also of a functional breakdown of expenses. So standard 13 is dealing with the accuracy of reporting of expenses. So obviously we're looking for you to accurately report the organization's expenses, and that includes joint cost allocation. Joint cost allocation is something that, depending on how large your organization is, you may or may not participate in. But what we're looking at really is when we look at your financial statements, are we finding any issues with the way that it's reported? So some common issues that we see: incorrectly claiming zero fundraising expenses. It's, our position is if you're reporting contributions revenue, then you're going to have some correlating fundraising expenses to bring that in. It might be very low depending on your organization. Maybe you rely primarily on volunteers to do work, but it shouldn't be zero. There should be some cost of office expenses or computer expenses or website costs if you're accepting donations on your website. There's some annual expense that you would incur that's tied to fundraising. And then next is special event revenue. There is a rule, an accounting rule that allows organizations to net out certain expenses from special event revenue rather than reporting it as an expense. But the rule states that the only thing you're allowed to net out is direct benefit to donors. So if you hold a gala and you have a meal and entertainment, the cost of the meal and entertainment is really benefiting the attendees. So you're allowed to net the cost of that from the revenue when you report it on your audit. What you're not allowed to net out is the fundraising expense. So we look for you to still be reporting the cost of invitations or advertising. Whatever you're doing, costs you're incurring to get people to attend the special event, that should be still recognized as a fundraising expense. And then another thing to keep an eye out for, let's say you have a sister organization or an affiliate that is performing fundraising on your behalf. Make sure that you're working with your accountant and your auditors to be clear about who's spending money to raise money. Is it you? Is it your organization? Is it your sister entity? If you have combined financial statements, it's still probably going to appear that way, combined in the combined audit. Just another thing to keep an eye out for. And then also just understanding what is a fundraising expense and what you're truly spending on fundraising. When you're doing the breakdown for that detailed functional that we mentioned for standard 12, you're going to go, for salaries, you're going to say how much of the fund of a particular employee spends on fundraising versus program activities, and break down their salary expense according to how much time they spend on those categories. And then you can go down office expenses and occupancy, and all of these things can be broken out. Just make sure that you're allocating to fundraising when you're doing that through the process. Yep. Standard 14 is dealing with the budget. So you should have a budget. Your organization should have an annual budget every year. And it should be approved by the board of directors, preferably before the year end of the year before. I know your budgeting processes differ from organization to organization, but just be sure that you're producing an annual budget and sharing it with your board and that they're approving it. As far as what our standard looks for, it should be board approved, and also it must contain specific information. That is, it should have total expenses for programs, fundraising, and administration. So just like with standard 12, with the detailed functional and the audit, you should have something similar for your budget. If we go to the next slide, you can see an example of a budget that if this alone were your budget, would not meet the standard. Because if you look at this, you have sort of what's called a line item budget, where you have all of your expenses listed out. but you can't tell from this, for example, how much of rent is being allocated to fundraising versus program and admin. It's just a one line item. So here's an example of, maybe this is page 2. Maybe after that line item, you have a functional breakdown like this, where you have just your totals of contributions and revenues at the top, expected revenues, projected revenues, and then your total projected expenses for programs, fundraising, and administrative below that. So if, for example, you didn't meet this standard and your budget looked like the previous slide, all you would need to do is create something that looks like this and create as an addendum to your budget, get the board to approve it, to fix it, and you would be able to meet the standard. And finally, there is an online tool from the Wallace Foundation. If you go to strongnonprofits.org, they have some interesting tools there, some very useful tools there for budgeting. If you're new to the process, it could be very helpful in putting something together for your organization.
Okay, so thank you, Sean. Let's talk about fundraising. Sort of a core reason why we have standards, the relationship between the donor and the charity. So Standard 15 is really the heart and soul of all that, requiring that all solicitations and informational materials that are distributed by any means, and that keeps changing, doesn't it, with digital communications these days, be both accurate, truthful, and not misleading, both in whole or in part. And the not misleading part is very important, because something can literally be accurate and truthful, but by withholding information or through graphic depiction could be misleading. So we're looking for stories and photos and solicitations that are up to date and accurate. Maybe 5 years ago, you had an amazing direct mail piece that just really produced well, but it made representations about an impact that really doesn't represent recent impact, or it refers to a stock photo as if it were the photo of an actual person served by your organization. So that would not be okay. You need to make sure that everything that you are depicting about your program is accurate about your program. Key facts relevant to the donation should be disclosed. So if there's something that's material and that could affect the donor's decision to give, and you're withholding that information, then that could contribute to fundraising solicitation being potentially misleading. Financial and success statistics, again, as Sean mentioned, we strongly encourage charities to avoid using overhead ratios when making fundraising appeals. You might sometimes see, 100% of your donation will go to affect the so-and-so program. If that is literally true, then we want you in immediate connection with that solicitation claim to explain why. And yes, we have asked organizations to prove those claims by providing financial documentation. If you're making claims about your program success, then if we ask you to substantiate that, you need to be able to do that with evidence. And of course, you have to show that your charity does what it says it's going to do with the donation. So it's always really prudent to be careful about what you say about how a donation will be used, because that's exactly how it has to be applied. And this is not just about protecting donors, although that's critical. It's about protecting your charity, because what you have to raise funds with is your charity's reputation. And you want to protect that reputation and the trust bond between your organization and your donors. So it's really important to be clear about how funds will be used, and to substantiate, as mentioned before, you have to use for the purposes and the solicitation. As Sean mentioned, zero fundraising costs. This is real eyebrow raiser. We have seen confusing representations or inaccurate ones about matching gifts. It truly has to be a matching gift if you're offering that as a way of trying to spur donations. We've seen vague claims about what the impact has been. Be clear. Inadequate use about proposed use of funds, sometimes with new and emerging charities, that's a problem. Or inaccurate or incomplete information about the financial state of the charity. that is related to our standard 10. In fact, if you are awash in money and you're not disclosing that, that might potentially be a way of misleading donors. Now, surprisingly, standard 16 about the annual report is sometimes it's missed sometimes by charities, less often now than in the past. But when annual reports moved out of a printed document onto websites, they started being produced in innovative ways, including things like videos. But the issue is that there are still donors who can't go to websites, they don't have internet access, and they might want to have something printed. So we ask for charities to have an annual report. It doesn't have to have that name. It could just be a document, but that provides the basics that donors want to know about. What's your mission? What is your charity in business to do? A summary of the past year's program results. What did you do, in other words, with donated money? A roster of the officers and members of the board, in other words, who's in charge, and a summary of the most recent financial information, including a total income, the total of income for the prior year, your expenses broken out into totals of program, admin, and fundraising categories, and then your ending net assets. Now, not often known, this can be your 990 if you don't have a printed document. The 990 typically has all this information in it. If you are using a 990 as a kind of annual report, try and make it clear. One of the things that's most often missed is having a clear description, not only of what your organization does, but what your organization did in terms of program accomplishments in the past year. And we would accept an online digital report if it can be printed out and sent to someone who requests it. But stuff that's scattered all over a website or emails that have gone out to your donors over the course of a year do not count as an annual report. And we sometimes hear from nonprofits, oh yeah, well, we're telling people all the time what we do. We send emails with updates and newsletters. No, that's not really what we mean by an annual report, and it is still very relevant. This is your primary tool, and it's ideal to tell it in donor-friendly language that shares with donors why they should make a donation to your charity. So while it doesn't have to be glossy or expensive or printed, it's your case statement about why you merit that person's donation. We look for this same information under Standard 17 on your website if you are soliciting donations by any means, and that means asking on the website for mailed-in contributions or donations made through the website, or inviting donors to call and make a donation or even text in a donation. Make it really clear, all the same information that we have discussed from an annual report. Publish your mailing address, your snail mail address, so that if someone needs to write you a letter, they can write you a letter and find you. Often with charities that are not legitimate, there is no contact address whatsoever, which is a problem. And then we also want to see electronic access to your most recent 990. That could either be a PDF that you can download from the website directly, or it could be a link to the 990 as it appears somewhere else. If it's on GuideStar, which is part of Candid, it could be a link to a page on GuideStar where your 990 appears. If it's to a charity regulator's website where that appears, then just label the link so people know what it is. Now, privacy is increasingly important to donors. Privacy and data security, in particular, under Standard 18, we call for you to offer donors an opportunity at least once a year to opt out of written appeals, or rather of solicitations in both your written appeals and on your website. That can be a checkoff, and you should have a clear and easily visible privacy policy. I've seen it hidden on websites. Make it really clear and easy to find, saying what information you're collecting from whoever is providing information to you, how it will be used, how to contact your organization to review the information, correct it, request that it be deleted, how to tell the charity not to share personal information outside the organization. That can be, again, a checkoff of what security measures are in place. We don't expect you to give away the crown jewels about what you're doing to protect data, but you should have data security measures, and you should say what they are in general terms, enough that someone will understand what they are. A thing to know about a privacy policy, I'm not an attorney, but my understanding is that a privacy policy it's a legal promise. And if you publish it on your website, the law will hold you to it. So you want to make sure that any policy you publish is something that you actually can do, will do. You need to monitor that you are doing it and perform that way. So it's not a good idea to go and swipe someone else's privacy policy and just cut and paste that into your own website. It is a good idea to have accomplished counsel, whoever your general counsel is or legal advisor, help you if you haven't got a privacy policy and you need to develop one. And again, the opt-out works for this. This is not part of the standard, but because cybersecurity is increasingly affecting charities, I strongly recommend that you look at these resources for cybersecurity information. Occasionally, we will do programs about this. There are some very, very simple things that your organization can do to help protect your data. One is to know what your data is. Train your staff to avoid things like phishing. That includes most particularly your chief financial officer, whoever's handling your books and has access to your bank account, because phishing and social engineering in particular are ways in which charities can be taken to the cleaners financially by scammers. Get the facts and take steps to protect your organization. Cause-related marketing doesn't apply to a lot of organizations, but it does apply to some. And this has to do with whether or not your organization is benefiting from the sale of products or services that state or even imply that you're going to benefit from a consumer sale or a transaction involving a monetary exchange. And what we're looking for is full disclosure. The who, what, when, where, and how. What are the terms and conditions that apply to this? Now, that could involve the actual or anticipated part of the purchase that would actually benefit the charity, say a percentage or a flat amount. If there is a time-limited duration, sometimes there isn't, but if it's only for a certain time period that has to be disclosed, please avoid using big terms like, and I see this a lot on cause marketing things that we review. A portion of the profits will benefit a charity. No, that's not specific. A portion of the proceeds, that's meaningless. Well, what are the proceeds? You could define that in any number of ways. So that wouldn't meet the requirement. You need to be much more specific than that. And in general, this is an offer to purchase, and these are terms and conditions that influence the decision to buy. So you should be disclosing any and all terms and conditions that could influence that decision. One example of that, so 5 cents will go to a specific charity for every bottle of juice sold in a specific time period, up to a maximum amount of XYZ. Something the Attorney General in our state has said is also make sure that you aren't making so many units of this bottle of juice that the maximum amount is exhausted before all of those bottles with the offer on it are sold. Because if that is not done, then you're going to have a lot of bottles with a cause-related marketing offer out in the marketplace that's making a claim that will mislead someone who wants to purchase. So, of course, you want to mention that there's a real charity involved. There are state laws in some states. Some of them can be quite specific. If you were proposing to engage in a major cause marketing campaign across state lines, my best advice to you is get qualified legal counsel, not just any legal counsel, but a legal counsel with expertise in cause marketing. Finally, we call for charities to respond promptly to complaints brought by either a local Better Business Bureau against a nonprofit or by the Wise Giving Alliance And we look for those organizations to respond appropriately to complaints. And yes, we do get charity complaints. Probably the most common one that we get is, how do I get this charity to stop soliciting me? So if you're making that really, really clear and easy for someone to opt out, you can avoid those kinds of complaints. And Sean, so do you want to mention the resources on give.org?
Sure. So everything that we've gone over today with the 20 standards is available on give.org. I know this is a long URL here, but if you just go to give.org, you'll find the link to the charity standards. You'll see when you get there that you can click on each of the 20 standards and look at the reason behind the standard, and then also look at the implementation, or what exactly we look for when we're applying the standard in a review.
And then I'll just mention, I'm sorry.
No, go ahead.
Yeah, FASB, if you really want a snoozy go to sleep bedtime document, look at the full list of nonprofit accounting standards. They're available on this website, fasb.org. Again, the Financial Accounting Standards Board is the entity that develops the standards that are used in nonprofit accounting, and which are called the Generally Accepted Accounting Principles, or GAAP. And those are the principles and the kinds of financial statements in which we're basing Better Business Bureau evaluations. There have been some new developments in that area, specifically on in-kind donations, which can get tricky in terms of fairly valuing the items or services that have been donated. So you can check that out again, and check with your accountant if you need more information about that. Sean? Mm-hmm.
Oh, yes. And of course, remember that the BBB does offer the charity seal, the accredited charity seal, to organizations that meet all 20 of our standards. Again, it's an optional thing. It's not something that every charity has to sign up for. But once you meet the 20 standards, it could be helpful to include this logo that you see at the top here. You can include it on your website, your appeals, any annual reports, documents that you produce. Just check with your local BBB about the licensing and the fees for the seal if you are accredited.
Right, and there is a licensing agreement that applies to that. So here's how to reach us. If you have more questions, I did take a quick look in the question box, and the number one question was, are you recording this and can I get a copy of the recording? And the answer is yes, including all of our stumbles and slide bobbles. You will get it all, warts and all, and you are welcome to communicate with us if you have more questions that you'd like to submit privately. We are very happy to consult with organizations about what might be necessary to meet any individual standard and to help you prepare to submit for a charity report. So I'm just going to take one more look to see if there are any other questions. The question box, and I do not see any. I'll give it another moment. I think we're almost at our time. We have about 5 minutes left. Any other comments, Sean, since we have a couple of minutes?
Well, just one comment on, we're talking about cause-related marketing. I would mention my recommendation, because I guess I should mention, we haven't mentioned that the BBB Wise Giving Alliance, the entity that I represent here, we evaluate the nationally soliciting charities, so the charities that solicit across the entire United States. Right. Local BBBs handle the charities located in their service area that are soliciting either regionally or locally. But with the national charities, and when it comes to cause-related marketing, we see it a lot more at the national level. And my recommendation is that you work with your legal counsel to develop a standard contract when you're working with a business that wants to engage with cause-related marketing. And part of that contract would be the language, like have standard language that you require the business to display at the point of sale when you're doing a cause-related marketing campaign.
And in some states, a contract is required. For example, in New York State, where we're located, the state requires a contract with any entity that is doing fundraising for you. And it's not really okay for another entity to raise funds for you without telling you, because that would be making use of your organization's name. Some people don't really know that your organization's name is a monetizable intellectual property. So it's actually up to your organization to protect that. And that relates to cause marketing. You have an obligation to ensure that no one uses your name without your prior permission. And I agree, a contract is a great idea. Be sure and check state regulations, because they do vary widely across states, especially if you might potentially be making a, say you're like partnering with a really big retailer that sells across state lines. It's so important to structure the agreement in a way that protects both your retailer partner and yourself, because there are fundraising and solicitation laws that apply in different states, and you want to make sure that you avoid triggering registration requirements that you don't want to trigger, or stumbling in some other ways legally.
Yeah.
So I think that's about it. And one last look to see if there are any questions. Yeah, I do see one. Is there a reason why Wise Giving Alliance and BBB? Not sure what. Important with which to partner, age and trust factor. So I'm not sure what's meant by that question, Sally. Thank you. I'm going to take a guess and suppose that it means like, why get a BBB charity report? And I will just say that our standards are holistic in nature, and they have been time tested. We rolled these standards out, when was it, Sean? About 2003.
Yes. Mm-hmm.
And then they were rolled out over a couple of years, and we have found through many years now that they have turned out to be a very good way. They're not, it's not a rating system. There are 20 practices that we look to see whether a charity is using, and those charities really are protective for the organization as well as for donors. Versus other organizations, well, I mean, it's all good, right? But at the same time, I would say that what sets us apart? A couple of things. One, these are voluntary reports. It's not robo-evaluation. We aren't just pulling 990s out of space and looking at that. 990s are often incorrectly filled out, one thing. So we are looking at GAAP-compliant financial statements. And the thing about GAAP-compliant financial statements is that it gives us apples to apples comparisons. And then we have a better basis for producing a charity report. Any other comments about all that? Sean, do you want to chime in and add anything?
I would just add that the big difference for us is our ability to work with you and a desire to work with you to meet standards. So it's not always possible to fix all standards, but we will at least provide you with the information that you need in order to do it and work with you to get there, for sure.
I agree with that. It's a very collaborative process. And in the process, we also have the opportunity to learn about how the standards have an impact on charities and what your insights are about it. So it's two ways. It's not a one-way street.
Yeah.
And I'm not seeing more questions. So I think that kind of wraps it up. And I just want to thank everyone for joining us today. And I want to thank Sean Van Border and Walter and Emmanuel behind the scenes who have been helping us present today's program. We will send out the recording of the video after this to all who registered. And with that, our event is concluded.